don't get your required correctly, you're going to have a situation where you're trying to spend some time, but you're answering the wrong question. So I want you to analyze your required. Most of students, they end up having a 42%. But when I sit down with the student, they realize that there's a part of the question that they did not address. But if they had addressed that part of the question, probably they were going to get half of the marks of that, and they were going to cross over to about 50%. Most of students that are getting 35 to 49%, I can guarantee you, it's not about you not knowing, right? It's never about you not knowing. It is all about, is it better now? Just confirm if it's better now. Okay, cool. Right. So I just want everyone to understand this aspect of saying, when you get a 35% and a 49%, I personally believe that you could have passed. Lack of exam technique is what is affecting a lot of students. So let's look at how do you approach a question when you are given a question. So the first important thing is that we need to understand what the examiner is looking for from us. And they normally give some additional instructions on how you're supposed to be addressing some of the things. So if you look at question number 1, it's saying critically discuss. So when a question says critically discuss, I'm going to park that now. In terms of the relevant accounting standard or standards, the journal entry processed by the financial accountant to recognize and measure the self-service system. At this point in time, I don't know what is this self-service system. Probably it's an intangible asset, but at this point in time, I don't know. But the question is saying critically discuss. What does that mean when a question says critically discuss? What does that mean when a question says critically discuss? You need to tell me things that were done correctly. You also need to tell me what was done incorrectly. That's what we call a critical discussion. Critically discuss, tell me what was done right, what was not done right. That's critical discussion. If a question asks for any concerns, or they are very specific to say they are looking for things that were done incorrectly, then in that case, you can focus on the wrong item. But if your question says critically discuss, make sure that you are talking about, if you see that this journal is correct, this part of the journal is correct, tell them that the debit entry of bank of 100,000 is actually correct. Then the credit entry is wrong. They put a wrong account, but the amount is correct. So I want you to be balanced in your discussion. That's what it means. Then from there, if we go to, please note, assume that the self-service met the definition and recognition of an asset on 1 August 2024. So when you're answering this question, we are assuming that the recognition and the definition were met. The recognition criteria and the definition was actually met on 1 August 2024. So now when you're looking at these journals, you're saying there is an asset that needs to be recognized. We are not yet sure which kind of an asset it is, right? Then from there, you are not required to discuss subsequent measurements. So just talk about what is there. Then your discussion should be supported by relevant calculations. So where you need to do some calculations to affirm that the amount was actually correct, then you need to make sure that your calculation is actually done. But guys, the other thing that I have seen students doing is that they go and do a calculation, and when they are taking the figures from the calculations in the statement of profit or loss or in the statement of financial position, they don't reference where they are getting this. So when you're doing your calculations, I suggest you number your calculations to say working number 1, working number 2, working number 3. So when you transfer a working that you have on working number 1, let's say it's in the statement of profit or loss, just right next to where you have written the description, let's say it's a revenue, just write working number 2. So it might be W2, and on the workings you have W2, so that your examiner can follow through. Actually, guys, they can be very strict, and some examiners, they might not be able to follow the calculations that were done that were not referenced. So let's try to, from today, when you're practicing your questions, make sure that you are going to be referencing your calculations. That's another thing that is going to be Very, very important. Okay. So we're going to come back to this question. But another part, they said you must not provide any journal entry. So they don't want you to do any journal entry. But let's say the question was asking us to do journal entries. Remember, a journal entry, for it to be correct and to be complete, it should have date, it should have narrations. Why are you processing a journal? Unless the required specifically says you are not supposed to include that. Okay, let's go to part B and let's talk about part B. Part B is saying discuss in terms of IFRS 15, revenue from contracts with customers, the amount of revenue that must be recognized in the financial statements of Afro Style Clothing Limited for the month of March 2025. This is a very good question. I like revenue, financial instruments, and any other topic that involves referring to the standard that much. I like that, right? Okay, let's, so here we're going to discuss IFRS 15 revenue. We're going to see what's happening on that, right? Please note your discussion should be supported by relevant calculations. So this is something very important. You must not provide any journal entry. So you're not required to provide any journal entry, right? Look, there's a marks for communication mark, logical argument. These things, they need to
so
be.
then we have to create a revaluation of 10,000. But under GRV, we said that we are going to restate.
Okay, guys, I suggest you mute yourself. Lungile Nyama. Where are you from, Lungile Nyama? Where is she now? Lungile Nyama, you share the surname with the presenter here. Where are you from? Okay, cool. Right, so guys, I strongly encourage you to mute yourself so that you don't take me off track, right? I just want to remain on track and I don't want to be disturbed, right? Mute yourself unless if you're saying something. Okay. Prepare the journal entries, tax-related journal entries included to account for the mid-run property in the annual financial statements of Afro Style Clothing Limited for the year ended 31 March 2025. Please note, dates are not required. Journal narrations are required. Very, very. So if you don't read this, you're going to leave journal narrations and probably there is a half easy marks for each journal narration that you're going to do, or even a mark. So guys, let's make sure that we read the instruction. That's why they even put it in bold to say, please note. They're trying to help you to say, come and see what is here and make sure that you make use of this information. Then if we go to D there, prepare the profit before tax note. A profit before tax note is going to be very important going forward. It's just a matter of saying whatever you have calculated that affect the income statement, can you put it in the disclosure note, which is known as the profit before tax note. So this is where you put like revenue from sale of goods, expenses, things like your depreciation, every expense that you might have must be shown in the profit before tax note. So we're going to look at it and just look at the number of marks. It's 18 marks. So as you do your calculations, just highlight to say that number, I might need it. So what I normally do when I'm writing an exam and I have something like this, I immediately go and do a template for that. Then I just write some of the things that I might need so that as I'm going to be doing my calculations, I can then quickly, easily transfer, because some of the figures that you're going to have here are the calculations that you might have already done here. And what I want you to do is once you are done with one of the calculations that you think affects my my profit before tax note, I want you to immediately transfer it to the profit before tax note. That way, you are actually making sure that you are going to finish your exam. Because one of the reasons why you guys don't finish exam is you want to approach a question when you are there. But if a question relies on the calculations that were already done, why don't you just throw those figures into the profit before tax note? Okay, we'll talk about this, but we want you to be very careful. I know I've calculated depreciation maybe somewhere. I've calculated the revenue somewhere. Why can't I just take it to the profit before tax note? Before I know it, maybe after I've done all these things and I've transferred the figures to the profit before tax, probably I already have about 13 out of 18. And there are just a few that I might need to do that are not, that were not covered up there. So when you complain to say maybe time was not enough or time is not enough in accounting, they are thinking that you are able to use the time that you are doing maybe part A, part B, part C to just actually put in something to the profit before tax note. Then the other question here is an ethics question. I think one of the things that SAICA requires from all institutions that are SAICA accredited is for each and every exam or test, there must be an ethics question. That way, we are trying to build our students towards a good ethical culture, right? So again, I don't like it when someone tells me that they did not do part E. So I'm asking you, how did the exam go? Then you did not cover part E. Then I ask you why. Time was gone. Why didn't you do this thing from the, like as your first question? Because I assume that you can be able to get 4 out of 3. So why are you not going to quickly do that kind of equation? Let's go and make sure that we do that kind of equation as soon as possible and make sure that we are able to get more marks. Okay, so guys, let's quickly go to the scenario. Guys, there are things that I want you to pick as we are going to be going now, and let's be intentional about it. So Afro Style Clothing Limited is a clothing retail company based in Centurion, Pretoria. The company was started by Mr. Maseko in 2016 and has over the years grown its footprint to 10 stores across South Africa. Afro Style has 3 product divisions: the clothing, the homeware, and the cosmetics. The financial year of Afro Style, so the financial year of Afro Style ends on 31 March 20. Sorry, it's just 31 March. We're going to look at which years are we being asked. But I think what is very important is if ever you find yourself trying to answer the question that you can't tell me when is the financial year end, you have a problem. There's something wrong with you, right? So before you do anything, just make sure that you know when is the financial year end. Otherwise, what are you going to be answering if you don't know when is the year ending? So I have seen students, they try to start answering the questions before getting the context of the scenario. And that is very bad. You can't do that, right? So it's just like starting to drive your car, but you don't know your destination. So where are you going? If you don't know the destination, where are you going? First, you know the destination, put the GPS and know where you're going. Or if you know how to get there, that's fine. But you need to have a destination first and you have an idea of how you are going to get there. Okay. Then from there, self-service system. During May 2024, Frostyle hired Hertz Technosys Hertz to develop a self-service point of sale system. The research phase of this project started on 11 May 2024 and ended on 28 July 2024. Guys, whenever they talk about whenever they talk about research phase, which standard comes into your mind? Which topic comes into your mind when they start talking about the research phase? You can put in the chat or you can unmute yourself and tell us. So that will be intangible asset IS38. Thank you very much. So one thing that you know in terms of IS38, during research phase, in most cases, you are likely to, during research phase, you are likely to expense the expenditure that have been incurred. So they are telling you that the research phase started on 11 May 2024 and it ended on 28 July 2024. And the total cost of the research phase was 1,318,000. So under normal circumstances, the research phase cost is going to be expensed. So it goes to the income statement, the statement of profit or loss. So do you see what I was trying to say? Let's say you started answering your question. You can see that there's going to be some research costs that I need to take straight to the profit before tax note, and I already have my 1 mark there or half mark, whatever the case is, but it might be 1 mark there. Okay. Then from there, the development phase started on 1 August 2024 and ended on 31 October 2024. Guys, let's just get this right here. Right. Costs that are incurred in development phase. I want you to tell me whether what I'm saying is true or false. Cost incurred in development phase is always going to be capitalized. True or false? Just to put in the chat there. Cost incurred in the development phase are going to always be capitalized. True or false? Tell me what you think. True, false, false. Are the ones who said false, is it because I said always? Yes, because I said always. It's not always. Development costs or expenditure incurred during the development phase will be capitalized only if a certain requirement have been met. And one of the requirements is that we have clearly indicated that this is an intangible asset and there's a criteria that we need to quickly look at here. Let me just check if I have something here. We have IS 38. Just want to show you something here, what they say about development cost. So if you come here, I think some of my students that are in this session, I think we spoke about this. So if you come to the standard, what it says, guys, everything that you get in the textbook, it's something derived from the standard. So it's high time you guys, you start also trying to get some information from the standard for yourself. An intangible asset arising from development or from development phase shall be recognized if and only if the entity can demonstrate the following. So these requirements should have been met, and I'm sure that you guys are very comfortable with this. So if you're not comfortable, please download the IS38, go to paragraph 57 of IS38, and make sure that you are very clear on some of the requirements that are required for you to be able to capitalize something. Okay. The projects needs to be viable. These are the requirements, right? Okay, all those items that you're talking about, they're emanating from paragraph 57 of IS 38. Okay, so here what they then said is, I think if you look here, so you can see up to 31 October, a fee of 118,000 was incurred and paid on 31 October 2024 to register a patent over self-service point of sale system. So we actually registered this patent. So the question is whether the 118 will be capitalized or it will be treated as a normal expense. It was incurred to register a patent. What do you think? We're going to come back to that. The self-service point of sale system became available for use as intended by management on 1 November 2024 and was expected to be used for a period of 6 years. So amortization is going to kick in. When something is now available for sale, we need to start depreciating that particular asset. And more importantly, when you're dealing with intangible asset, for you to be able to amortize it / depreciate it. So we need to be able to amortize it. We're going to use the word to amortize. We're going to amortize the intangible asset. So when you amortize the intangible asset, we expect that you have the useful life that is given. If the asset is going to be used and there's no specific useful life, in other words, it's indefinite useful life. So in that case, you are not going to amortize or depreciate that particular intangible asset. So I think that's very important there. The total cost incurred and paid during the development phase amounted to 21,197,800, which included 3 physical self-service kiosks at each of the 10 stores. 3 physical self-service kiosks. Okay, so it included 3 physical self-service at each of the 10 stores. The amount of 21,197 did not include the cost of registering the patent above. So we need to think about it. Are we going to register the patent and include the registration cost? Each self-service kiosk was purchased for 75,000 Rand. Right. So we are seeing that there's a self-service kiosk, right? There's a self-service kiosk that is included in the items that we have here. So maybe the question that I have for you guys that you need to answer me is, do you think the self-service kiosk will also be part of the intangible asset, the kiosk itself? do you think it will be part of the intangible asset? I just want to hear what your thought there.
No.
Okay, so that one, are you going to treat it as PPE? Is that what you are saying? Is that what you're saying? It is a physical substance. I'm liking what you're bringing in there. So you're saying the kiosk has got a physical substance. So what I should then do is to separate it from, you guys are, okay. I think I'm liking that. Let's see. Okay, that's what you're saying, guys. That's what you're saying. And I think I'm happy with what exactly you're trying to say there. I'm happy with what you're saying there. So the intangible asset should be treated separately. Then the kiosk, the one that we can see, we can also treat it separately. That's what you guys are saying there. Okay. I think we will come back to that, and let's make sure that we do the right thing with that particular aspect. Okay. Right, any question? So what we're going to do is we're going to take the 75. So we're going to check the 75,000. That's for each kiosk, and there are 3 at the 10 stores. That would be 2 million. So we need to get rid of 2,250,000 from that amount. So we need to reduce it with 2,250,000. Okay, cool. Then from there, I think one of the most important thing is also to take note of the fact that in addition to an amount of 600,000 was incurred and paid on 1 November 2024 to train staff on the use of the self-service point of sale system. Who can tell me, what are we going to do with this 600,000? What are we going to do with that 600,000? Expense it.
Training expense.
Okay, we're going to expense it. There's something that I want you to see. Do you see that it's another expense that I can take directly to my profit before tax note? This is something that I can take directly to my profit before tax note, and I'm building some marks there already. Okay, I think we're going to focus on that because I don't want anyone to say they didn't finish. Because if you guys are able to finish the exam, there's no reason why you should fail. It is expected that each self-service kiosk will be used for a period of 5 years, after which it will be sold for a residual value of 10,000. So that kiosk that we said we are going to take 2 million from that. I think we spoke about the 2 million somewhere. That 2 million, we're going to depreciate it. We are actually going to include it in the depreciation, but we're going to consider 10,000 as the residual value for each kiosk, and we're going to depreciate it over a period of 5 years. When I look at this, this is a very simple question. All costs incurred were paid in cash. The financial accountant of AfroStyle processed only the following journal entries to record the above transactions. So they put the full amount as transaction cost. That is definitely going to be wrong. So what we need to do is to tell them what was included in this figure that we feel like it's not supposed to be included. So what they did is they did the research cost that is supposed to be expensed. Then they also put part of the development cost, and they put the training cost. So one of the points that you are going to see and get marks is the accountant incorrectly capitalized 1,318,000 that relates to the research cost, which was incorrect. This amount must be expensed. You get a full mark there. You go to the 600,000, the accountant incorrectly capitalized the training cost, which was supposed to be taken as a training cost as an expense in the statement of profit or loss. Another mark. Then we go and analyze what we'll be having in this amount and see whether that was correct. Of course, we already know that they included the 2,250,000 that relates to something that is not, that is actually identifiable, right? That we're supposed to consider there. We were not supposed to consider it as part of intangible asset, but as part of PPE items or equipments. All right, guys, do you see that the first 7 marks already, you have an idea of how exactly what, actually, if you put the points that we have already said, you already have about 4 out of the 7. I don't know if it makes sense to somebody. So you'll be moving and you already have your points, and you just put it down as quick as possible. Let's go to sales. Self-service sales. All Afro styles stores are cashless. At each store, there are 2 security guards and 2 kiosk assistants. Each item has a radio frequency identification price tag. Customers place the items into the self-service kiosk. The self-service point of sale system sums up the prices on the items by wirelessly reading the RFID tags. Customers proceed to make payment using their bank cards or their Afro-style store cards. If purchasing on credit, they use their Afro-style store credit cards. Once payment has been accepted, the kiosk prints out a receipt. Customers pack the items into Afro-style branded paper bags, which are kept next to the self-service kiosk. At the exit, a security guard checks the items in the customer's bag against the receipt. Reward points, reward program. On 1 March 2025, Afro-style introduced a customer reward program in an effort to boost sales and increase customer retention. Credit customers earn reward points by scanning their Afro-style store cards at the point of purchase. Customers paying through their bank cards earn reward points by entering their cell phone numbers, which are linked to their digital profiles. Customers, guys, if you can mute yourself if you are not saying something. Okay. Customers earn a reward point for every 3 rand spent at Afro-Styles stores. The reward points can be utilized against the future purchases at a ratio of 20 points for 1 rand. The reward points must be redeemed within 24 months, after which they will expire. Afro-Style expects 80% of all reward points to be redeemed before they expire. During the month of March 2025, Afro-Style made total sales of 11,760,000. 40% of the sales were on credit, while 60% were on cash. 90%, sorry, that's why I encourage. Okay, so let's just quickly look at this. There is a very important aspect that is coming in here. 90% of the total sales qualified for the reward points. 15% of the reward points awarded during 2025 were redeemed during the same month. Guys, this is something that is going to come for you throughout your studies up until you qualify to be a CA or whatever the case is. One thing that I can tell you is there's an assessment that I wrote for APC preparation, the last board exam, last Saturday. There was a question that was actually 2 tasks that wanted us to discuss issues of loyalty points and all those things, reward points that are given to customers. So this is a principle that you need to be very comfortable with. And if there's someone who has attended our classes when we covered revenue, I think they will tell you how we went through this. So what we did is we looked at the illustrative example that is provided in the standard, and we illustrated how loyalty points should be accounted for, which I'm going to do for the purpose of this session so that everyone is very comfortable. I don't want to see anyone losing marks because you could not do the allocation of these transactions. So when you make a total sale of 11 million, but there's an issue of reward points, just to know that when you look at your sales, there's sales related to the sale of goods, and there's something that relates to the loyalty points itself. So you need to make sure that the allocation is done correctly there. Okay, guys, I'm going to just try to mute. I think some people will be joining, so I think we just need to frequently remind each other that we need to do that. So on the revenue, guys, I want you to make sure that you listen very carefully to what we're going to do with this kind of equation. I'll be happy to see what you guys think, and I'm going to open the floor for you guys to make contributions. Midrand property. On 1 July 2022, Afro-Style purchased a property in Midrand with the intention to use it as the company's new head office. However, immediately upon taking transfer of the property on 1 September 2022, Afrostyle abandoned its plan to relocate its head office to Midrand. Instead, management decided to rent out the property to other companies in order to earn rental income. Rental income of 173,900 was earned from the property for the year ending 31 March. So this one is again an item that you can put on the profit before tax note with no issues and get your half mark or 1 mark there. So let's always make sure that we identify things that you can highlight it in a certain color to say this one I can take it straight to this, or I can do some little calculation. So let's always do that, guys. The property was purchased at a cost of 4.5. 3.2 of the purchase price was allocated to the building, and the remaining 1.3 was allocated to land. So we need to make sure that for the depreciation, maybe we are going to be doing some depreciation. Then for the land, maybe we are going to be doing some revaluations, which is going to be very important. So guys, maybe you need to tell me what we are going to do in this question. The question that I have for you is this question: are we going to take it as an investment property or we are going to take it as a PPE item? You can tell me there. Are we going to treat it as an investment property or we are going to treat it as what? Guys, let me know what you think. Do you think we're going to consider, okay, cool, let's see, investment property. But right at the beginning, do you see that this would have been considered as what? As a PPE item. They wanted to use it for the new head office. So we were supposed to take it as a PPE item. But because there is a change in use, and we are now looking at it as an investment property, so we're going to take it as an investment property. So I don't have a problem. If you guys decide to, so they purchased on 1 July, but ownership only took place there. So what I can do, I will do a transfer to transfer something from a PPE, and I transfer it to be an investment property. But someone might then argue to say, but look, it's not going to matter because from 1 July up until 1 September, it was not yet available for use probably, right? So we're not going to have any problem there. All right, so we are also given the cost there. Then we are given the fair values for the land and the building. So we are given the fair value on 31 March 2024 and on 31 March 2025. So we can see that there is a fair value movement there. There's an increase in fair value. So we also need to look at something called the fair value adjustment. So we're going to look at fair value adjustment. So what I'm going to do is just to look at the difference between these two amounts here. What do I get as the difference there? If I do 4,950 minus 4,730, I'm going to get 220 as the fair value adjustment. Why can't I immediately take this figure to the profit before tax note? Before I even finish reading the question, I already have a number of things that I can immediately take to my profit before tax note. So you can't tell me that I'm not going to finish this exam. There's no way. SARS grants a Section 13 Queen tax allowance of 5% per annum on the building only, not apportioned for the part of the year. The deferred tax liability relating to the Midrand property was correctly calculated at 136,080 in 2024. So we then need to calculate the one for 2025. Then we look at the movement in that deferred tax and probably whatever the question is asking us to do. So the next one, guys, there's a Rustenburg store. We are almost done with reading, guys, and we start answering the question, and you're going to enjoy the answers because we already have most of the answers in our mind. There's a Rustenburg store. Sales at the Rustenburg store have been sluggish since the COVID-19 pandemic. Despite the gradual return to office nationwide and the implementation of various initiatives, the sales volume have not recovered to pre-COVID levels. The board of directors of Afrostyle decided at its board meeting held to sell all the assets of the Rustenburg store in a single transaction and reassign the affected employees to other stores. All the requirements to classify Rustenburg store as a disposal group held for sale were met on 1 October 2024. So this is something very important. So we also have non-current assets held for sale, and let's see how we're going to deal with that. So these are the carrying amounts of this particular asset before the sale. So we do have the carrying amount of the assets that we are given, and the total carrying amount is, so for the March, we have 391. Then we're going to have all these amounts together, right? So probably what we need to do, so we are given the carrying amounts there on 31 March 2024. But that was on 31 March 2024. And this decision, it's something that was done on 12 September 2024. But the requirements were met on 1 October 2024. So the other thing that we need to do is to calculate what is the carrying amount on the date when the requirement was met. What is the carrying amount on that particular date? Right, then from there, so we're given the carrying amount on 31 March. So we are not going to use these carrying amounts. We need to do a further calculation to see what is the carrying amount some months later to make sure that we have the carrying amounts on the 1st of October 2024. I hope that makes sense, guys. The decision was made on 1 October, but the carrying amounts that we are given, it's on 31 March, which means we need to further depreciate things like your machine, things like your equipment. We need to further depreciate. And in terms of inventory, we need to know what is the inventory that was there on 31, on the 1st of October, right? Then the same with accounts payable. So let's just quickly read through that. The machine was originally purchased on 1 August 2023 at a cost of 525. The machine became available for use as intended by management, as well as brought into use immediately on acquisition date. We're going to have a break at quarter past or 20 past, right? 20 past 3. But we'll be done with answering some few questions. On 1 August 2023, the machine was estimated to have a total consumption of 500,000, after which it will be sold at a residual value of 30,000. The machine produced a total of 55,000 from 1 April 2024 to 30 September 2024. So the reason why they are giving you this information is for you to be able to do further depreciation before something was classified as held for sale. Remember, guys, once something has been reclassified to be held for sale, we can't continue depreciating that asset. So we need to calculate the depreciation for this particular asset up until 30 September, a day before reclassification. So we're going to calculate depreciation for this, and it's also going to go to the profit before tax note. That 18 marks, I can tell you, you can kill it. On 1 October 2024, the value in use and fair value less cost to sell of the machine were correctly determined as follows. The value in use is 310, then the fair value less cost to sell is 295. Remember, under normal circumstances, when you're doing the calculation of impairment, we look at the higher of value in use or fair value less cost to sell as our recoverable amount. But we're going to come back to this because remember, once you reclassify something as held for sale, we also need to make sure that we correctly account for it. Okay. SARS grants a Section 12 Cap C tax allowance on the machine at a rate of 40/20/2020 in each of the years of assessment, not apportioned for part of the years. You did capital allowances recently, guys, so I think you should be fine. The equipment was originally purchased on 1 May 2021 at a cost of 420 and became available for use as intended by management on the same day. Equipment was brought into use on 1. Remember, we start depreciating the asset when it's available for use, not when it was brought for use. But for the purpose of SARS, when it was brought into use. The useful life of the equipment was correctly determined to be 6 years, and an insignificant residual value was allocated to it. On 1 October 2024, the value in use and fair value less cost to sell of the equipment was correctly determined. So this is what we had. Then SARS grants a Section 11. Just remember, Section 11 requires you to apportion. So even if they don't tell you, just remember that you're going to apportion. But luckily, they did tell you. Inventory had a net realizable value of 105 on 1 October 2024. The carrying amount of accounts payable remained unchanged at 63,000 on 1 October 2024. Then from there, we also have on 1 October 2024, the value in use and fair value less cost to sell of the Rustenburg store was correctly accounted as value in use was 550, then the fair value less cost to sell was 480. So the question is, what value are we going to take there? Right? Very, very important. Okay. Then I think there were no further impairment of disposal group subsequent to initial classification as held for sale. Right, I think we are almost done with the reading part. We also took time because we went through the required and we're trying to explain some few things. Right, then from the agreement with Kasi Vibes Clothing Pty Limited, as part of its commitment to empower local communities, AfroStyle entered into a 3-year agreement with Kasi Vibes Clothing Pty Limited, KVC, an upcoming clothing manufacturer in Tembisa. In terms of the agreement, AfroStyle will provide free mentorship and market assistance to KVC. In addition, AfroStyle will provide the use of 3 high-end sewing machines to KVC at an annual payment of 40,000 payable in arrears. As part of support for KVC, the agreement states that this payment will decrease by 10% annually. The machines were delivered to the premises of KVC on 1 July 2024. AfroStyle will collect the machines at the end of the agreement on 30 June 2027. So in other words, what they are doing is they are actually giving an upcoming manufacturer a right to use some of these equipments, right? So maybe you guys, you can tell me, what are you expecting to get from this one? I don't know what is the implication. That should be IFRS 16. Do we all agree? Do we all agree that this is part of IFRS 16? So this is more like income that is going to come as operating lease income. So we gave someone the right of use of an asset, and that particular asset, we are only going to be getting something like 40,000. And we are the lessor. So we need to determine whether this will be classified as a finance lease or it will be an operating lease. But the good part, the question already told us that this agreement with KVC did not meet the requirements for classification as a finance lease. So this is an operating lease. So when you have an operating lease, remember you need to equalize the payment. So they are decreasing. We just need to put them together and we divide it over the number of months. Then we put an equal amount in our calculations. You're going to see what we're going to do there. New supply proposal. The procurement manager of AfroStyle, Lebogang Mpofu, who is a chartered accountant, received a proposal from a supplier in Southeast Asia. In terms of the proposal, the supplier offered to manufacture and supply clothing for AfroStyle at a discount of 50% to the current prices. Upon doing background checks on the supplier, Mpofu discovered that the supplier illegally hires children as young as 7 years who often work under very poor working conditions. Nonetheless, she intends to accept the proposal as she is of the view that the supplier's business operation and employee issues are none of your business. Furthermore, this proposal would lower cost, boost profits, as well as a performance bonus. So since this person is a chartered accountant, is obliged to comply with the CPC, yes, ethics. So we're going to look at the codes of professional conduct, the CPC. I think in auditing, you guys, you discuss CPC in more detail. So what we want you guys to do is to think about the CPC, to say the code of professional conduct as a CA, what is expected from you. So in this case, we're going to look at that. We want to talk about the best way to answer this particular question. So as a CA, they are obliged to do the right thing. Integrity is something very important. And also, we need to make sure that we maintain professional behavior. So if this person is going to accept this, it means that the professional behavior part is not adhered to. So integrity needs to be looked into. We also need to look at the issue of self-interest. So this particular person, the reason why she wants to accept this is going to help her in her bonus. So that speaks to having personal financial interest, personal self-interest. So she was supposed to consider what to do with that. So basically also the fact that they are hiring children as young as 7, that might affect the brand of AfroStar. Because if you are known that you actually deal with suppliers that does that, it might also reflect the unethical parts of your organization. So when you discuss these things, as far as a person is a CA, we need to make sure that we tell them that we need to apply CPC. Then we start looking at item by item. CPC requires you to maintain some high level of ethical standards and making sure that you are doing something that is within the law, right? So hiring illegal children that are less than 7 years, it's something that is illegal. So when you're dealing with someone who is doing something illegal and you're CASA, you have already violated the code of professional conduct. We can look at what are the things that they put there. But I think the approach is what matters. But you don't bring a CPC where the person is not an accountant. A pre-tax discount rate of 11% should be applicable. Owner-occupied lands revaluation model. It is the company's policy to realize any revaluation surplus upon disposal of the underlying asset. Owner-occupied buildings are accounted for using the cost model. Depreciation on the building is accounted for using the straight line method over 30 years. Equipment is accounted for using the cost model. Depreciation is on straight line method. Machinery, production methods, cost model. Intangible assets, cost model, straight line method. Investment property, fair value model. Okay. Taxation, 27%, capital gains, 80% inclusion rate. You may assume that both the tax rates have been effective and remain unchanged since 1 April 2016. Deferred tax is provided for on all temporal differences using the statement of financial position approach. There are no items causing temporal differences or exempt differences except those identified in the question. The company will have sufficient taxable income in future against which any unused tax losses and tax debit balances can be utilized. The reason why they are giving you this statement is for you to understand that if you have something that gives rise to deferred tax asset, please recognize it. They anticipate to have enough taxable income in future. All amounts are material. You may ignore the implications of the VAT. So let's quickly answer the first question so that we can quickly take a break. So we're going to answer the first part and the second part, then we take a break. Okay, so the first part, guys, I want your help in terms of this. So we need to make sure that we apply. So when you look at the first part is saying critically discuss in terms of the relevant standards, the journal entry processed by the financial accountant. So when you're asked to critically analyze this, we need to make sure that we are very clear. I think one of the reasons why the figure we said was wrong is because they had included things that were not supposed to be, they included things with physical substance, right? So I think we need to still go back to the definition of what are intangible assets, and we discuss what should be included and so forth, right? So guys, you need to make sure that you check how UNISA answers the question so that you don't lose the marks as we go. But I think we've already highlighted key important issues that we want to do here, right? Okay. Okay, so I think one of the things that we need to talk about here, so they are talking about the kiosk, then they're also talking about the system, self-service system. So guys, in terms of the definition of intangible asset, I think you should go up there. It talks about something that without a physical substance, right? It talks about something that doesn't have a physical substance, okay? If you come here, intangible assets, right, just check here. They talk about amortization asset, but I want you to check where they talk about the intangible asset itself. So intangible asset is an identifiable non-monetary asset without physical substance. I can end there to just say an intangible asset is an identifiable non-monetary asset without physical substance. Then I go ahead and tell the examiner that from what I'm seeing, the self-service system is an intangible asset because it does not have physical substance, okay? But I also go ahead and tell the examiner that the kiosk itself, let me go to the kiosk. So I can tell the examiner that the kiosk, where is the kiosk now? The self-service kiosk has got a physical substance. Therefore, it's not an intangible asset, right? Very short what I'm saying. Then I go and say, the accountant was right to include, the accountant should account for self-service as an intangible asset. However, the accountant is not supposed to include the 1,318,000 that relates to the research phase. That's an expense, number one. Number two, I need to go and tell the examiner that the cost for the kiosk itself must be treated as a cost to the equipment, right? And must not be accounted for as an intangible asset. I think we have mentioned this, right? Then the cost of registering the patent. What do you guys think? Do you think the cost of registering a patent should be capitalized or it should be expensed? Just tell me what you think there. The 118,000 of registering a patent, do you think it should be included as part of the cost of an intangible asset or it's not? Capitalized as an intangible asset. Thank you, guys. Thank you. I think you know what you're talking about there. It needs to be capitalized, right? So we've already discussed a number of things that are very critical. Therefore, we might now need to come back and say, the inclusion of 1,318,000, we said it was wrong. The inclusion of 600,000 for the training, it was wrong, right? On the 21,197, they were not supposed to include the 2,250 that we have already calculated. It was not supposed to be included. But the cost of registering a patent of 118 was supposed to be included. Okay, let's see if it was included already. A fee of this was incurred and paid. It was not yet included. So we were supposed to include it. So what you can then do is you can calculate how much was supposed to be included. So the fact that they have an intangible asset in the bank there, that's fine. We are critically evaluating this journal entry. They don't want us to do any other journal entry. So the journal entry for the intangible asset was supposed to have, if we are now to do the correct calculation, we are going to take the 21,197,800. We are going to subtract the 2,250. I hope everyone knows where the 2,250 is coming from. Is the one from the kiosk that was for 75. There were 3 of them at 10 stores, 3 each at each store. So it's 75 times 3, then you multiply 75,000, please, times 10 stores. 75,000 times 3 times 10 stores. Okay, that's how we got to the 2,220,000. Okay, any question? So what we are saying is the actual cost was supposed to be 21,197 minus 2,250. Then we were also supposed to add the 118,000. Okay. I don't know if I'm very clear there. Just tell me if that gives me, or you can start with the 23,115,800 and you subtract the 318,000, then you subtract the 600,000 as well. then you add the 118, or you can do it alternatively the way we did on top there, but you're going to also subtract the 250,000. I hope that makes sense to somebody, guys. Just to let me know if this is making sense. So if you do this, what is the new amount that was supposed to be recognized? You also get a mark for showing that calculation to say this is what was supposed to be done. Any question, guys, before we move on? But in most cases, these kind of questions, they come with a lot of available marks. So you might even miss one thing, but you can still get it right. Or you prefer the subtraction. Yeah, you can come with this one. But it's almost the same, because with this one, what we did, we used the figure that did not include these figures. But I think it would be good to use this method because it shows you that you know that you are supposed to remove this, you're supposed to remove this and remove this and add that one. Okay, happy with the first question. I don't think we need to waste time on that. You guys, I think you are very clear now in terms of what we are doing. Any question before I move on? Any question, guys? Any question, guys? Is there any question, guys? Are you clear with that particular question, why we are doing something? Does it give you a picture of how intangible assets IS38 works? Okay, great. Okay, great. All right. Let's quickly go to, guys, I think what is very important in everything that you are doing, because the exam is always going to be different. But if you can get a bigger picture to say, what are we doing here? And if you can also be able to do a mind map to say, look, when I'm looking at intangible assets, these are the important things that I need to think of, and I need to be very careful of 1, 2, 3, 4 things. Okay, now we want to move to another question. We're going to have a break just after this question. So just to pay attention, guys, I know it's not easy to focus for some long time without a short break. So we're going to just do this question. Then from the short break, we're going to do this one in the intangible, the profit before tax. And let's see how we go. That was a 50-mark question. So the question is asking us to discuss in terms of IFRS 15 revenue from contracts, the amount of revenue that must be recognized in the financial statements of Afro Style Clothing. Your discussion should be supported with, right? I think this is where I always tell my students to apply the 10-step revenue process, right? So I'm going to apply the 5-step. Where am I getting the 5-step IFRS 15 5-step revenue approach? Right, so who can tell me what are the 5 steps that we need to think of? Step number 1, what should we do when we are dealing with revenue? Step number 2, what should we think of? Step number 3, what should we think of, right? Then we're going to have step number 3. What else? Step number 4. What else? Step number 5. I want us to answer this in this way, and let's see if we won't be able to get this. So step number 1 is to identify a contract, right, with customer. Okay, we're going to come back to applying that. Then step number 2. So in some interviews, they ask you such things. Identify the contract transaction price. I don't think the next step is, do you think it's, I want the 5-step approach, right? So contract, then performance obligation. Okay, yes, 2, it's identify performance obligation. Oh, sorry, you guys, you put it differently. Identify performance obligation. I know I normally just say PO, performance obligation. Then I'm going to be able to determine the transaction price, the TP, the transaction price. What I want you guys to do when you go to your standard, try to go on performance obligation. Read what they speak about on performance obligation. Read what they talk about on transaction price. Read what they talk about on the next one that we're going to do. Step number 4, we're going to look at recognizing revenue. So we actually have to allocate first. Allocation. of transaction price to performance obligations, right? Then lastly, number 5, I think on number 5, we are going to say recognize the revenue, right? Some of the revenue you recognize at a point in time, or you are going to do over time. So it's very important to identify which ones are going to be done over time, and which ones are going to be done at a particular point in time. Okay. Right. So the contract, I don't think was a big deal in this question. It's not all the steps that will then be big deals in this question, right? I think from a contract point of view, they already have a contract. If I'm to check it correctly here, how do we know when to use 5-step approach? So when a question, maybe let me put it in this way. It's not always that we want you to put the 5-step approach, but some of the things that you're going to discuss, like performance obligations, is part of the 5 steps. So maybe just to have a picture before you start answering the question, then you come back, you ask yourself, which areas is the question asking? So in this case, I think let's come back to the question. The question was asking us to say, just check this. What the question says is discuss in terms of IFRS 15, the amount of revenue that must be recognized. So for you to be able to know the amount of revenue, you need to be able to have the transaction price, and it must be allocated to performance obligations. But you can't do that without knowing the performance obligation. So definitely these steps becomes very important. Step number 2 become very important. Step number 3 become very important. And step number 4 to allocate becomes very important, and the part of recognizing becomes very important. The contract itself, not necessarily very important. But do you see why we are saying those 4 steps are very important? For you to know how much, you need to know first what is the transaction price. And once you know the transaction price, you must be able to allocate it to the performance obligations. For you to be able to allocate to performance obligation, you must be knowing how many performance obligations do we have. I think that makes it very clear. Just to let me know if you still need some explanation there. Guys, if I'm moving a bit fast, please let me know. I don't want anyone to be left behind. So we're going to come to the revenue. I'll try to be very slow when I'm going through the revenue part. Okay, cool. Right, I'm going to try to be very slow when I go through the revenue part. Let's look at the rewards program. On 1 March 2025, AfroStyle introduced a customer rewards program in an effort to boost sales and increase customer retention. Credit customers earn reward points by scanning their AfroStyle store cards. So we have already read that. But I think what is very important, I think let's identify, do we know what is our transaction price? So what is the performance obligations that we have here? We have a performance obligation to deliver the goods, and we also have a performance obligation to deal with what we have agreed on this reward points. So we have a performance obligation to deliver the goods, and we are also going to have an obligation to make sure that we give them the loyalty points. So how many performance obligations are we going to have? To deliver the goods and to give them a discount through loyalty points. So there are 2 performance obligations. So I can go and say, you need to explain what is a performance obligation. So a performance obligation is a promise to deliver something to someone, right? So when you make a sale that is going to result in any material right to the customer. So when a customer has got a material right, in this case, they have a material right to get a discount, then in that case, we are going to have a performance obligation. So at this point in time, we have 2 performance obligations. The contract is already there, guys. 2 performance obligations, that is to deliver goods sold and to give discount through the loyalty points. So the customer has got a material right to receive the discount, right? Give discounts. So in this case, the customer has a material right to, customer has got a material right to receive a discount. So that's why we are saying it's a performance obligation. Let me see what you have, guys. Let me just admit someone here. What did I admit? Let's see. 2 performance obligations. I'm happy. The transaction price, you said it's 11,760,000. Happy with that. So transaction, you also need to just explain what is the transaction cost. So the transaction price. So this is an amount that the entity expects to receive or to be entitled to from this transaction. So the transaction costs is actually given as 11,760. I want you guys to go back to the standard, look at what is considered to be a transaction price. What are the things that we look at when we are deciding what is the transaction price? Just to keep in mind, transaction price does not include the VAT. If a company is a registered VAT vendor, we are looking at the transaction price, and the transaction price only is made up of the amount that is excluding the VAT. Okay. Any question before we move on? Any question, guys, before we move on? Any question before you move on? Okay. Right, so the transaction price, we have it. Guys, once we have the transaction price, I think the next thing that you need to understand is now the allocation of the transaction price. What is the basis that we use to allocate transaction price, guys? What is the basis that we use to allocate transaction price? Anyone? What is the basis that we use to allocate transaction price? Anyone, guys? Standalone prices, right? We allocate based on what we call standalone prices, right? So we're going to look at what we call standalone prices. Then we're going to look at what is the percentage. Then we're going to allocate the transaction price. So we already know that the items that we have is the sale of goods, right? Then we are going to have the one that relates to the rewards point. The one that will entitle someone to the points. But in total, the transaction cost should then make 11,760,000. So that will be the transaction cost that we're gonna allocate, right? Right, then what is the other thing that we need to look at, guys? I just need to make sure that we are very clear. So let's calculate the standalone prices. Guys, what is the standalone of selling? So let's say we were to sell this and we don't give anyone a discount. Do you think the price will then change? Guys, I think those who have, maybe if you have access to our revenue one, just to check what we did there. So let's say you received 10,000 from the sale of goods. So what we are trying to say, even if there were no points, you are still going to sell. Even if you are not going to give someone a discount in future, you are still going to sell at 10,000. So in this case, I want to make it very clear to say the standalone price is not going to be changed. The standalone for the sale of goods will be the same. So you're going to see it being exactly the same here. But what we then need to do is to calculate what is the standalone for the reward points. But maybe to put it in simple terms, what we are just trying to do is to try to understand what discount are we going to give these particular people. So let's look at it in this way. So they said they are going to sell 11,760,000. Then they said 90% of these total sales qualified for a reward point, right? So let me start there. So we are saying 11,760, but we are then saying 90% of it qualified for reward point. So how much of the sales qualifies for the reward point? 11,760 times 90%, we get 10,584,000. So we are saying these are the ones that qualifies for the reward points. Let's just make sure that we are very clear. We are still together on that one. Then I think there's something that I want to go to now from there. I want you guys to pay attention to this. If these are the guys who qualify for the loyalty points, I just want you to understand this. I just want you to understand something. They said customers earn reward point, 1 reward point for every 3 rand spent. So what does that mean? I'm going to just take this amount, I divide it by 3. What do I get if I do that? Because for every 3 rand spent, you're going to get 1 point. So if we have 10 million spent, if I divide by 3 rand, how many points are we likely to get? 10, 5, 8, 4, 1, 2, 3 divided by 3. Then I get 3,528,000. Right, so these are the points that we are going to have. But there's something very, very important that we need to take into account when we do this. Afro Style expects 80% of all rewards points to be redeemed before they expire. So what we are trying to say here, we expect that 80% is going to redeem the points before they expire. But one thing that I want everyone to understand, so we already have 3,528. So we want to check, we want the 80%. So what it means is the 80% of the points are going to be redeemed before they expire, and the other 20 are going to be redeemed at a later stage. So what do we do in that instance? You can just tell me what you think we should be doing there. You can tell me, guys. You can tell me. Guys, tell me what you think.
We have a contract liability
Okay, but
of
I think
80%.
So you are saying I'm going to take the 3,528,000. Then you're saying I should multiply it by 80%. Is that what you're saying?
Yes.
Okay. Okay, so if you do that, what are you going to get?
Okay, 2,822,400.
2 million?
822.
400. And what is this? Are these points, or this is monetary value, or what is it?
Points.
These are points.
Yes.
So we expect 2,822 points to be. Okay. Right. So I think if we come back to our question, it gives us some information. I just want you to check something here so that you do have this number of points expected to be redeemed. Right? Can you see this? But I want you to see this in terms of the points that you get. I think there's a if you look at this point here. So they say the reward points can be utilized against the future purchases at a ratio of 20 points for 1 rand. So if I have a total of 2,822,400 points, I need to divide them by 20 for 1 rand. So I'm going to divide that amount by 20 points because for every 20 points, this is not 20 rand, but this is 20 points. That's very important. It's 20 points, 1. So this is the number of points, and we're going to say 1 rand is equivalent to 20. So this is how we're going to get the rand value that we need. So this is going to be the stand-alone for the reward points. So I'm going to come to the reward points. They write 141, 120. Guys, if you have any question, you're more than welcome to ask me. But it's all about just reading that part carefully and make sure that you are very clear on what's happening. If you still have any challenge, guys, you're more than welcome to even ask me even after this session. I don't have a problem. I will be able to assist you. Any question, guys? Right. Then in terms of transaction price, we can just take the 99% times this one. If there's anyone who attended my revenue session this year, please just let me know if this makes sense to you. Right. I know it normally becomes a bit of a challenge, but please, I want you to sit down, be intentional about what you are doing, and let me know if you understand this. So we have done the allocation of these revenues. So that's the revenue. So this amount of revenue must be recognized now, right? At a point in time. When the sale happened. Then this one, it depends with whether people actually came to utilize some of the items. So let's just see. They said 15% of the reward points awarded during March were redeemed during the same month. So the one for the for the month of March, 15% were then redeemed. So what we are going to do, the transaction price that we are going to record. So I already said, guys, this amount, the 11,620 needs to be recognized now. Then out of the 139, they said 15% was already recognized. So what it means, we are going to recognize the 20,000 right straight away. So the 20,000 needs to be recognized. So the total revenue to be recognized is now going to be equal to, so this is the total revenue that is going to be. So the total revenue, guys, what's happening here? Where is my, okay. I don't know what's happening with my mouse. But guys, do you understand what I'm saying? So this amount, there's something wrong with my, okay. So what I'm trying to say here is the 11, okay, just give me a second. I'm just trying to make sure. Okay, so this amount, oh, something is not right. Okay, my thing is not moving. I don't know why. Guys, we're gonna have a short break shortly. Just wait a moment. We just want to finish something. What's happening with my mouse and everything here? Okay, so what we are saying here, something is not right here. What's happening? Guys, I hope no one took control of my things here. Okay, so the 11,620 and the 20,917 must be recognized immediately as revenue, but the other portion will be revenue from the revenue from the reward points, and the other one from the other one. Anyone with a question, guys, before I move on? Anyone with a question? So this was particularly for March, but you are going to see that the profit before tax that we are dealing with, it's not necessarily only for March. So what it means is we might need to, okay, I think we're gonna close this. Yeah, but guys, do you understand what we have done so far? Right, we're gonna, guys, don't leave the session. We still have a long way to go. There are a number of things that we really need to go through. I want you to look for other questions that look similar to this one. Make sure that you go through it. If you have any question, you're more than welcome to ask me and I'll assist you. So when you come back, guys, we're gonna go through the journal entries that are required here. Then we're gonna also do the profit before tax note. So let's be back at exactly, so let's be back at 1542. We just need about 7 minutes to refresh. We'll be back just now. Okay. Guys, when you come back, please remind me to resume recording. I want to just pause it so that when people are watching the recording, they don't need to wait for long. Okay, for now, I'm going to pause it. Up here.
Hi, sir.
Yes.
Hi, sir. How are you?
Good.
Can you please repeat the calculations of amortization?
Okay, just allow me to
The one
quickly
we're
do this.
doing of 9.
Okay, just allow me to do this. Guys, we had forgotten to re-record,
Okay.
but if you look at what we did on investment property, we increased it by 250, being the difference between the fair values that we have here. I'm going to quickly go to that. So the fair values that we have, it's basically so the fair values that we have, I think we calculate, it's this amount minus this one. So if we do that calculation, I think you get 220,000. So that's the fair value that we increased our investment with, and we got a gain on fair value adjustment. Then from there, we did a calculation of the deferred tax. In 2024, we had a balance of 136. Then we also had the carrying amount equal to the fair value. Then the tax base, what we did is we looked at the 1.3 cost of the land. Then we took the 3.2 minus 5% times 3 years times the 3.2 to get the tax base. So we then added the tax base for the building to be specific plus the 1.3 to get to the 4,020,000. However, when you calculate that deferred tax, you need to make sure that you look at the 4.950, the carrying amount, and the tax base of 4,020,000. But you need to make sure that the difference between 4,950 and the cost is going to be treated using the CGT, and the difference between 4.5 and 4,020,000 is going to be used at the 27 because it's below the cost. Then after that, we came to the issue of the profit before tax notes, the fair value gain, we already have it. The operating lease income, what we did is we looked at the first year, 40,000, second year, 36. Then the third year, it was 32,400. We get the total. Then we divided by the number of months that are in the contract to get to the 3,000 and something. Then we multiplied it by 9 months because we had used, we actually leased it out for 9 months during the current year. So that's why where you get the 3,011 times 9 months. Then the rental income from investment property was 173. It was given in the question. Then the research cost was also given in the question. The training cost was given in the question. The amortization, what we did here with the amortization, we looked at the cost of the intangible asset that we initially calculated. Then to calculate the amortization, they said the intangible asset will be used for 6 years. So what we did, we took the cost divided by 6 years times 5/12 to get to the 132. So that's how we got to that. Any question, guys, before I proceed? So I'm going to proceed now to what we have done. So we had gone through the question without recording. So I just need to do a wrap up on that. Okay, any question, guys, before I start? So I now need to talk about the depreciation of other assets. So which other assets, guys, are we going to talk about that needs to be depreciated? Other assets that we might need to depreciate, guys, let me know. There is this machinery and this equipment. Can you see that? There is that machinery and that equipment. Can you see that? Any question? Any question? Any question, guys? Yeah, no question. Okay. Sorry, I think I just take a bit of some flu here. The Vandadi. Sorry, I was saying I have a bit of some flu. So let's depreciate the machine. And guys, just to keep in mind, so this machine, we are going to depreciate it from when? From the beginning of the year, which will be 1 April 2024, up until the decision to reclassify it as current assets held for sale was reached, right? So all the requirements were met on this date, which is the 1st of October. So it's up to the 1st of October. So how many months are we looking at to stop depreciating the asset? When do we stop depreciating the asset? So how many months are we looking at there? How many months depreciation should we consider? How many months should we consider for depreciation, guys?
6.
Right, we're going to consider 6 months: April, May, June, July, August, September, 6 months. Don't count the October. So we are going to consider 6 months. So when we do our calculation for depreciation, let's make of those ones, right? So let's quickly do that for the machinery. So we're going to look at the machinery. So the machinery, the carrying amount here was this one, but they gave us further information to say it was originally bought for 525. The machine became available for use as intended by management on the 1st of August 2023. On 1 August 2023, the machine was estimated to have a total production of 500, but for this period, they had done 55. So what we're going to do is we're going to take 525. So we're going to take 525. So the machine, so we're going to look at 525. Then I'm going to divide it by 500,000 units that we expected. Then I'm going to multiply by 50,000 units. I hope I have the figures right there. 55,000. Right, 55,000. Just to confirm if this is clear, guys. So what we're going to do is to say 525,000 divided by 500,000. Then I'm going to multiply by 55,000. So that will be the depreciation that we're going to have for the machinery. Any question before I move on? Any question, guys, before I move on? So these are the depreciation figures that I'm going to have that I'm highlighting. Okay, so we're going to also go and do the depreciation for the equipment, the same process. What we're going to do is we are going to look, but guys, when you use the, when you use the units, you don't need to look at the number of months. Do you realize that? When you use the number of units, you don't need to, was there any residual value on this one? Yes, if there was any residual value, let's subtract it. It was 30,000. Thanks for that. So we're going to subtract 30. Thank you very much for that. So I'm going to subtract 30,000 there. Right? Thank you so much. Yeah, it's those little things that can also make you lose marks, right? So here we're going to first subtract 30,000. We're going to close the bracket there. Okay. Right, so that will be the machine. Any question, guys, before we move on? Then the next one, let's look at the equipment. So for the equipment, guys, what are they saying on the equipment? Equipment was originally purchased on 1 May 2021 at a cost of 420 and become available as intended by management on the same date. The equipment was brought into use on 1 June 2021. The useful life of the equipment was correctly taken as 6 and the residual value was 0, right? So what we're going to do is to take 420 divided by 6 years. Residual value is 0. So we're going to take 420,000 Then you're going to divide by 6 years. Any question? Any question, guys? 420,000, we divide by 6. We get 70,000. But we're going to multiply this by the number of months. How many months did we use it? For 6 months as well, because we decided to change like
9 months.
Was it 9 months? Just to be very careful, we are looking at from 1 April 2024 up until we decided to up until 30
Okay,
September,
thanks.
right? So that's where we are getting the 6 months. Okay, cool. Thank you guys for participating on that one. So that's what we're going to have. So the total depreciation, guys, I don't think, do you have other items that we need to depreciate? What about the machine that we are renting out? Are we not supposed to also depreciate it? The machinery that we are leasing out, are we not supposed to depreciate it as well? I'm asking about this one.
Operating lease.
Yeah, the one that we bought for 300,000. Are we not supposed to depreciate it as well? It is our asset, right?
Yes.
So what are we going to have there? Let's calculate the depreciation on this one, on the leased assets, right? So the amount was 300,000 and there's no residual value on this one, right? We were not given what is the residual value there. Insignificant residual value in 5 years. So we're going to take 3 years divided by 5. But it's very important that that asset, we still had it throughout the period. So we're going to just take the 300 divided by 5. So we're going to look at the leased assets. So it's going to be 300,000. 300,000 divided by 5. Right? So we're going to have 60,000. So we're going to divide by 5. Then we're going to have 60,000. Right? So the depreciation that we're going to calculate, we're going to take a total of 1, 2. That's why we are saying reference your calculations so that the examiner knows what you're talking about. So the depreciation is going to be the 364, right? I just hope that it makes up, it gives us the correct total there. Guys, just check if our depreciation is correct there. But I believe that the first one is 54. Then the depreciation on the kiosk is how much?
I think there on the 70, you put 70 and it was apportioned for 6 months. It's 35.
Which one? Oh, yes, that one for the machine.
Yes, the one where we got 70,000. Yes, that one.
Or the equipment. When I did the calculation, I didn't show what I showed on my calculation. Oh, okay, I see what you mean. So I was supposed to multiply by that, right? So it then automatically changes our depreciation figure to that. Any question before I move on there? Right, let's do the impairment, guys. I think we were supposed to have another break, but our time is no longer allowing us, guys. I think what we can do. So what we need to do when you calculate impairment, guys, we need to know the carrying amounts at the date of carrying amounts on the date that we are taking these assets. So for the machinery, it's going to be easy. So for the machinery, guys, I'm going to take the carrying amount that I'm already given. What is the carrying amount that I'm already given? 391,350. So I'm going to take 391,350. That is the carrying amount that was given at the beginning of the year. And I further depreciated with how much? With 54,550. 54,550. Is that right? Are we all in agreement there? 54,450. Right? So we're going to have the carrying amount here. 391,350 minus 54,450. Right? Then you're going to have this amount here. Then from there, we go to the equipment. What is the carrying amount of the equipment? The equipment, the carrying amount is going to be 227,500. So I'm going to have 227,500, the one that I was given. minus the depreciation of the equipment that I did there, the 35,000. So what I'm saying here, I'm going to have 227,500 minus 35,000. Then we get this amount. Then from there, what else are we going to have? Inventory, I'm going to treat it separately. Then the accounts payables, should I put it together? You guys, you need to tell me now, when I do the IFRS 38 impairment, when I do that one, do you think, I think this is something very important that we need to consider. All right. So what we're going to do here, guys, we are already given the fair value less cost to sell and the fair value for the machinery. So let's do the impairment for the items that are within the scope of this. So these are the carrying amounts, and I want the recoverable amount. Remember, guys, the recoverable amount is the higher of the two. So for this one, I'm going to take the 310. Is that right, guys? So I'm going to take the 310. It doesn't matter, because what is happening is we still apply the rules of IS 36. I know that I'm going to sell it, but I still need to consider the higher of, I think I'll put it together and share with you guys. Sorry, for the equipment here now, for the equipment, what is the fair value less cost to sell? What is the recoverable amount for the equipment? So for the equipment, the recoverable amount is the higher, which is 200. You need to tell examiner that you are looking at the higher of the two. So what is going to be the impairment? Carrying amount is this, recoverable amount is this, so there is impairment there. But on the second one, is there impairment? No impairment. Right, so there's no impairment there. Does that make sense to somebody? So these are the assets that are within the scope. Guys, I just want you to understand something. The only assets that will be dealt with in terms of the scope of IS 36 is these two. Inventory, there is a built-in mechanism for impairment under IS 2. This one will be dealt with in terms of financial instruments. So in terms of the impairment that I need to calculate in respect of IS 36, it's just that 26,900. So IS 36 impairment, let me just do the IS 36 impairment. So the IS 36 impairment is going to be equal to, guys, why didn't you remind me to increase my font again? So the IS 36 impairment that I'm going to have there, impairment. Okay. So the IS 36 impairment that I'm going to have is basically this amount. Where did I put the calculations? It's this amount, because the other one doesn't have impairment. Then we now need to do another. Let's do the inventory write-off. So the inventory write-off, guys, inventory was at 112,000 on this debt, but let's go to 4.3. So if I go to 4.3, inventory had a net realizable value of 105 on 1 October 2024. What do you think we should then do with the inventory write-off? We just look at the difference between 112 and 105. So we're going to look at the difference between the 112 and the 105. So write-off for inventory. Do you guys realize that there was a lot of easy marks here? 112 minus 100. Just in knowing your standards and have the basics, you are going to make it. And this is a past exam paper, and you should be able to do this. So that's the inventory write-off. So I think I've covered quite a number of things. I've covered all this. The only thing that I'm left to cover is the impairment. The impairment, but I'm now looking at IFRS 5 impairment, right? So what I need to do when I do IFRS 5, guys, it's very important that I look at what is my carrying amount of my disposal group. So the carrying amount of the disposal group. So I'm now going to put the machinery. I'm going to put the equipment. We are almost done, guys. Just pay attention there. Then the inventory. Then I'm going to have the payables, right? Just remember the payables will be subtracting, right? So the machinery, the carrying amount of the machinery, guys, I think I've done this calculation already. The carrying amount of the machinery and the equipment are given as there. But I want you to understand something that is very, very important here. Because now I'm in IFRS 5. So when I have IFRS 5 now, what I need to do, there was no impairment. So these are the values that I'm going to do. The machinery, it was impaired, so the new value is 310. Equipment, there was no adjustment, so the new value is 192. So I'm going to come here and I say the machinery, I'm going to come this and take this amount here of 310. Then for the equipment, I'm going to come and take this amount here of 192 because it was not impaired. Then for the inventory, it was impaired and we had 105 in terms of our calculation. Then for the payables, let's look at the payables, what happened here. So the payables, what happened? It was 63. Then they said to us it will remain unchanged. So we're going to use that 63. So we're going to have the 63,000, right? So this is the carrying amount of the disposal group. So this is the carrying amount of the disposal group that I'm going to make use of. So that's my carrying amount of the disposal group. Anyone with a question before? Guys, just to keep in mind, this one is subtracting. Disaster there. The payables is a liability, so it will be subtracted. So now what we need to do, and we need to go and compare it with the fair values that are currently given. So now the value in use is no longer applicable. So here for the group, you no longer use the value in use because we are now applying IFRS 5. So we are going to use a value of 480. So the fair value is 480,000. We no longer take the higher off. So we're going to have an impairment of the difference. So we're going to have an impairment of 64,500. So we are going to have an impairment, IFRS 5.1, that will give us this amount. Any question before we move on? Happy? Done with the question, guys. Thank you very much for attending. I strongly encourage you guys, if you're really serious